Welcome to The Explainer. Today, we're tackling something that usually feels like a completely intimidating foreign language, US accounting. But, here's the real secret. It's literally just the language of business. We're going to dive right in to how accounting takes the incredibly messy, chaotic reality of everyday transactions, every coffee sold, every bill paid, and transforms it all into this crystal clear, understandable story of financial health. Okay, let's start with a really provocative question right out of the gate. If a local coffee shop makes 10 grand in sales this month, how in the world could it still be on the fast track to bankruptcy? I mean, it's a terrifying thought for any entrepreneur, right? But this hooks right into an absolutely crucial concept, the massive gap between simple cash flowing through the register and true, sustainable business profitability. So to answer that question and completely demystify the whole process, we're going to follow the chronological journey of a brand new local business. Let's meet ABC Coffee LLC, setting up shop right in the heart of New York. We'll watch them grow from day one and see exactly how their story is told transaction by transaction through the incredibly powerful lens of accounting. Every business starts with a massive leap of faith. And our story kicks off with a bold first step. The owner invests exactly $50,000 in cash straight into the business bank account. It's a hugely exciting moment. But from an accounting perspective, this simple deposit just triggered a massive chain reaction. Here's the crucial point. That initial investment, it activates the absolute foundation of all accounting. We call it the golden accounting equation. I want you to picture this as a giant, perfectly calibrated scale. Everything a company owns, its assets, must always, without exception, perfectly balance against what it owes to others, its liabilities, plus the owner's remaining stake in the business, which is the equity. Now, to record that very first deposit, an accountant doesn't just, scribble it down in a notebook. They record a formal journal entry. They debit, which just means add to, our cash assets by $50,000, bringing that side of the scale up. And to keep things perfectly level, they immediately credit the owner's equity by the exact same amount. 50 grand on the left, 50 grand on the right, keeping our scale perfectly balanced. Let's move to the next transaction and see how this builds. Say the owner buys a $12,000 espresso machine and they pay in cash. Well, our cash goes down by 12 grand, sure, but our equipment assets go up by 12 grand. We literally just swapped one type of asset for another. Total assets remain at exactly $50,000, so the scale stays perfectly balanced. But things get really interesting when ABC Coffee buys $2,000 of premium coffee beans on credit. We get the beans, so our inventory assets go up by $2,000. But we haven't actually paid for them yet. Because of this, our liabilities also increase because we now owe the supplier. This is a liability known as accounts payable. Both sides of our scale just got a little heavier, but they are still in total harmony. Eventually, the doors open. And as the shop starts serving customers, we really have to contrast two very different ways of viewing the business. Simple cash basis accounting just records transactions when cash physically changes hands. Pretty straightforward. But accrual basis accounting records revenue and expenses when they are actually earned or incurred. And as we're about to see, this accrual method paints a much more accurate picture of a business's true operations. Let me show you exactly why that is. For example, under accrual accounting, if ABC Coffee does $5,000 of corporate catering in January, but the customer's invoice says they don't have to pay until February, well, they still recognize that revenue in January. Why? Because they did the work. This is absolutely vital to understand because it proves that earned revenue does not equal immediate cash in the bank. Because a modern business deals with this incredibly messy mix of immediate cash sales at the register and delayed credit payments from catering clients, we really need to draw a hard line. We have to contrast basic bookkeeping, which is the essential grunt work of just recording and organizing the numbers, with true accounting, which actually analyzes, interprets, and reports on what those numbers mean for the business's survival. To keep all this daily chaos completely organized, accountants rely on a strict, repeatable framework called the accounting cycle. It kicks off by hunting down daily transactions from messy source documents, like crumpled up receipts. Then we analyze what they mean, record them formally as journal entries, and finally post them into the general ledger. Think of the ledger as basically the master record book where all the accounts live. The cycle then finishes up with a series of crucial checks. First, we verify that all debits actually equal credits using a trial balance. We also make necessary adjustments for things like accrued expenses, bills we've incurred but haven't actually received in the mail yet. From there, we prepare the major financial statements, deeply analyze vital metrics like profit margins, and finally, close the period so we can start completely fresh next month. Section 1, the big 3 financial statements. First up is the income statement. This is essentially your profitability scorecard. It cleanly takes our total revenue, say $14,000, and subtracts the cost of our beans, which is our cost of goods sold, along with operating expenses like rent and wages. What's left at the very bottom reveals ABC Coffee's actual net income or profit, in this case, $4,000 for the period. Second is the balance sheet, and you can really think of this as a financial photograph. It acts as a snapshot of our original golden equation, completely frozen in time. On one specific date, it shows exactly what the coffee shop owns in total assets, exactly what it owes in liabilities, and the owner's remaining equity. It proves instantly that the business is perfectly balanced. Third is the statement of cash flows. Now, remember our question earlier about making $10,000 but still going bankrupt? This is the statement that answers it. It categorizes the actual physical movement of money into operating activities, like selling coffee, investing activities, like buying that espresso machine, and financing activities, like that initial $50,000 deposit. It tells you exactly where your cash went. Now, to ensure everyone from Wall Street to Main Street can actually trust these statements, U.S. businesses have to follow a standardized, highly rigorous rulebook. It's called US GAAP, which stands for Generally Accepted Accounting Principles, and it's established by the Financial Accounting Standards Board to make absolutely sure every business is using the exact same measuring stick. But here is a fascinating twist. The book income reported on these standard financial statements might not perfectly match the taxable income you actually report to the government. Why? Because government tax rules often require entirely different treatments for certain expenses or investments. So your GAAP profitability and your tax liability, they're actually two completely distinct realities. Ultimately, why does all this tedious recording and balancing even matter? Well, because this translated financial information is vital for absolutely everyone. It's for the owner who's desperately tracking profitability. It's for banks verifying loan repayment ability before they hand over capital. And it's for investors actively assessing the company's overall health and future potential. Let's look at the true power of this analysis. While a simple bookkeeper might just smile and tell you the shop made $200,000 in sales, an expert accountant goes much, much further. They look at the trends. They're the ones warning you that your gross margin, the actual profit made on your products before overhead, just dropped drastically, and that your operating expenses are ballooning out of control. One gives you a number, the other actually saves your business. So, as we wrap up this explainer, the ultimate takeaway for any entrepreneur, manager, or investor is this. Are you content just recording numbers in a notebook and hoping for the best? Or are you ready to use the profound language of accounting to truly understand the dynamic, living story of your business? The numbers are talking. What are they telling you?